Hi, everyone. Welcome to another episode of Orrick Live. Today's episode, we're going to get a glimpse into the intriguing world of tech mergers and acquisition. We're going to talk a little bit about what the process is. We're going to talk a little bit about how companies should prepare for a sale process in their life and ways to maximize the value in the process, and also a little bit about what founders should focus on, because as you will see, there's a lot to do. So joining me for this episode is Mark Seneca, a partner in our mergers and acquisitions and private equity team, and a first-time guest on this show. Welcome, Mark.
Thanks, Aria. Happy to be here.
And also joining us is John Bautista, who viewers of the show will know is a partner in our technology companies group based out of our San Francisco office. Welcome back, John.
Thanks, Aria. Glad to be here again.
Well, thanks to both of you for joining us and giving us your time to discuss this really interesting process that a company goes through when it is being sold. So, Mark, maybe I can kick it off with you. Maybe give us a little bit of an idea of kind of your experience with sale processes. How many of these do we typically do in a year? And what is a sale process? Maybe kind of tee it off for us.
Yeah, thanks, Aria. Orrick is, as many of you know, is an international law firm. One of our core strategies is technology, and we have a large presence in Silicon Valley, where I spent my career doing technology M&A. In our technology company group practice, which makes up a segment of our clientele, we've got over 4,000 clients, companies at various stages of development that are venture-backed in all areas of technology industries: telecom, technology, media and telecom, SaaS, mobile, AI, machine learning, fintech, ed tech, biotech, food tech. We've got companies in software, e-commerce, in crypto and blockchain, in gaming, in big data, augmented reality, robotics, and others. So our clientele covers the gambit of technology space in a lot of exciting areas. And the vast majority of those companies, as they either grow through acquisitions, but their ultimate liquidity event is by and large through acquisitions by serial acquirers. We have done deals across virtually the who's who of serial acquirers in Silicon Valley and beyond, have sold companies, and in many cases, multiple companies over the years to acquirers like Meta, Facebook, Alphabet, Google, Microsoft, Amazon, Salesforce, Twitter, VMware, Intel, Oracle, and IBM, newer entrants like PayPal, Adobe, Nutanix, Reddit, LinkedIn, Juniper Networks, Palo Alto Networks, and the list goes on. And so we have a rich experience in growing companies on the one hand and successfully selling them to like I said, a laundry list of the serial acquirers that create the ecosystem for liquidity in Silicon Valley and beyond. In terms of our activity year over year, we probably are involved in anywhere from 200 to 300 M&A transactions, and they run the gamut of early stage acqui-hires to unicorn multi-billion-dollar exits and everything in between. And so we have quite a breadth of experience in running these processes, advising our clients, and being able to help them navigate through the different approaches that these serial acquirers employ in doing deals.
That's really interesting, and you touched on a few things that we want to come back to in this episode, including differences between acqui-hires and transactions that are just for billions of dollars. But before we get there, John, you see these companies kind of from their infancy all the way through these exit events. As Mark mentioned, is the most common type of an exit for a startup company. So in that journey, when do you think a company should think about getting ready for exit, and what kind of should they be thinking about, the founders and the executive team?
Right. Well, it's never too early, and as Mark pointed out, M&A is the most likely liquidity option for the company, the other being an IPO, capital markets transaction, or sometimes companies will stay it alone as a private company. Stripe is a good example of that, which is a company that we represent. Just completed a major venture financing for them, and very likely that they will stay private for a while longer. But since M&A is core to many company strategies, it is important to think about it from the very beginning of the company. And that means thinking about it when the company's being set up, in terms of making sure that all the intellectual property that needs to be in the company is in the company, making sure that the company has the right legal structure to maximize for M&A. For example, it's important that the founders, if they can, control as much of the voting rights as possible. So many times we will set up companies where early employees and early investors will grant voting proxies to the founders. That way the founders, if they decide it's time to sell, they can easily be able to consummate the sale transaction. And looking at how employee equity is structured, making sure, for example, that there are not sort of broad acceleration of vesting provisions in employee equity, and it's tailored in a way that'll maximize value at a company sale. And also looking at who's on your cap table, who are the investors in your company. It's probably important to make sure you have a limited number of investors, and that investors in your company are not possible competitors, either to your company or to potential acquirers of your company. So being very focused on who will be on the cap table. Also focused on what other rights are granted to investors, making sure, for example, that a particular investor or groups of investors don't have veto rights on an M&A transaction, or they're limiting the veto rights that they may have on an M&A transaction. So all of these topics around intellectual property, around voting rights, around cap table management, employee agreements, and acceleration of vesting are important topics that come up from the very early days of setting up a company.
Yeah, and we've talked about through the prior episodes about how important it is to set up the company properly and grow it and scale it properly, and this again brings that into focus. So I think any of our viewers that want to review some of those episodes, they should go ahead and do that. But to your point, really important to set up the company properly. The adage is an ounce of prevention is better than a pound of cure. So that's again holds true in this context. Mark, do you want to take us maybe through what a typical M&A process kind of looks like, maybe from the sell side perspective? So that's the company being sold, and maybe touch on some of the points you raised earlier about what an acqui-hire is, for example.
Yeah, in terms of this concept of preparing and growing your company, perhaps with the end game in mind, you think about what are the exit opportunities, and it's on a continuum. At every juncture of a company's growth, they're constantly evaluating the risk of execution and building value versus valuation and an exit opportunity today. And that extra opportunity come very early in a company's life cycle, an acqui-hire stage, where new first-time founders are looking at the difficulty of building a business. They're looking at getting financed. They look for an opportunity perhaps to hone their skills on a more established platform and to have their team continue to build what they started. And that's the phenomenon of acqui-hires and the war for talent in Silicon Valley. And then as you grow through different venture capital financing and growth stages, you look at the market for capital, and you look at the space in which you're developing your technology and a decision to go from development to commercialization. And that's another inflection point where you look and say, how difficult is it going to be for us to commercialize this product and increase value on our own versus combining with another company and selling at that juncture? And so at every stage of a company's development, having the end game in mind, develop relationships with the logical acquirers, get to know them, develop those partnerships and commercial relationships that will often lead to opportunities to maximize value down the road. When I talk to first-time sellers about the process, I really describe the M&A sale process as an exercise in controlled chaos. And chaos because it's so intensive for a period of time, typically 30 to 60 days of intense, full commitment and an all-consuming effort. And it's a series of parallel processes that start at different stages in the process. But once that parallel process begins, it continues in parallel with others until the end. Typically, you start out with a party showing interest and you negotiate a letter of intent. Once the letter of intent is signed, you go into exclusivity and you start a due diligence process, both on business due diligence, in which an army of buyer lawyers and business folks descend upon a company. And while they're still trying to do their day jobs and run the business, they are being asked to uncover every deal that they've done, every document that they've entered into, every IP that they've developed. And it is a exhaustive process. You then, shortly after the due diligence production and review process begins, the parties started negotiating definitive transaction documents. And you'd typically have about a 100-page merger agreement and a slew of ancillary agreements that include employment agreements, investing agreements, non-competes, shareholder written consents, escrow and paying agent agreements, agreements relating to all the different flavors of securities that are outstanding, whether they be options, warrants, safes, convertible notes, and others. You also have a process of developing disclosure schedules, which are the exceptions to the reps and warranties. You've got a regulatory process and antitrust filings. You've got tax analyses and parachute payment analyses. You've got disclosure of the entire process and deal in the form of an information statement and soliciting consent from stakeholders. You've also got the allocation spreadsheets and funds flow that are the implementation of the deal and who gets paid what and when, third-party consents and closing condition satisfaction, and then a closing process. All of those are in and of themselves very detailed and complex work streams, and they start, as I mentioned, at different stages and go through the end. And so it becomes, for those that haven't been through the process, lawyers can explain all of that on the front end, but it isn't until you live it that you see how labor intensive, how exhausting, and how detailed and comprehensive a buyer's review of even earlier stage companies, and certainly that's the case with respect to more mature companies. Our jobs as lawyers is to control that chaos, to give the founders and the management team and the stakeholders and the board comfort that things are being handled, that all of these disparate work streams are being coordinated, and that we're keeping people apprised. And the other thing that's very critical in these processes is timeline. Time is enemy of all deals. There's things that can come into the mix that change the risk profile of deal execution. It's distracting, and it needs to be done in a very concerted way and coordinated way in order to have a successful outcome.
Yeah, not to mention that at the same time, the founders are trying to run a company and build a business while doing this massive process. So, the more time you take up doing this, the less time you have for actually growing your business. John, I don't know if you wanted to jump in, but I had a follow-up question there for Mark, and also want to get your thoughts on that point. And that question is, Mark mentioned that the whole process starts with this thing called a letter of intent. And then you get into this controlled or sometimes uncontrolled chaos of the deal process. So, maybe at a high level, because I know we could spend the entire episode just talking about the letter of intent, but maybe at a high level, get both of your thoughts on how much of the economics, or what would you put in the letter of intent? Maybe just give us a little bit of overview of what a letter of intent looks like, as opposed to all these massive agreements that Mark listed. And maybe we start with John, kind of get your view as just general advisor to companies, and someone who's been with the company probably all their lives, and then Mark's as a M&A specialist.
Yeah. Well, I mean, the letter of intent is a term sheet. Just like we see in venture financings, we will have a term sheet. And for the most part, the buyer is incentivized to keep it really short and leave out a lot of the details. Of course, the most important detail is what the purchase price is. But from the seller's perspective, the more detail that's in the term sheet, the better, because that eliminates negotiation or renegotiation down the road. And why is that important? It's because the buyer will require that the seller enter into an exclusivity provision, also known as a standstill provision, whereby the seller will not, or a no shop provision, where the seller will not shop the deal to anyone else. So as soon as that letter of intent or term sheet or memorandum of understanding, it comes in a variety of flavors in terms of the name of the document, is signed, then the seller is locked in for an exclusivity period while the definitive documents are being negotiated. And while the seller is locked in, the seller cannot talk to anyone else. All other discussions come to an end, and the seller cannot solicit or entertain offers, any competing offers. So it really is the end of one process, which is that negotiating process to get the best deal, and the commencement of the next process, which is getting that deal that's outlined in that letter of intent, to a point of execution, which is the acquisition agreement that Mark just outlined, and then ultimately the closing.
So sounds like at the LOI, when the LOI process ends and the LOI is signed, it sounds like founders give up a lot of leverage. Mark, would you agree with that summation? And what are your other thoughts?
Yeah, on the sell side, a lot of times there's founders are just anxious to get to the next stage of the game. And we're constantly advising them that while there has to be a balance between detail and speed and getting to the next stage, you lose leverage once you get past the letter of intent and you've gone exclusive. And so there's a handful of things that you want to get right at the term sheet stage. That includes the purchase price, as well as what are all the adjustments to the purchase price. Another main component of overall consideration is a bucket of retention consideration that is allocated to employees for go-forward retention, in addition to the purchase price. There's also the strings attached in the form of the indemnity construct, or in many deals these days, whether you can impose upon the buyer having its sole recourse be rep and warranty insurance that it buys and pays for. You also want to have a sense of what the buyer is going to do with employees, both on the retention incentives, but also on requiring them to be stay on as employees as conditions to closing. And so there's a laundry list of key items that you want to have implemented and understood before you go exclusive. These term sheets can be done very quickly. They can be done in less than a week from start to finish, but there needs to be coordination between the client and their lawyers that have experience with the nuances to maximize that process.
Mm-hmm. And how would you to suggest that a company maximize value that the stockholders of the company receive in this kind of transaction? Maybe John, we'll start with you again on this.
Right. As was pointed out, having leverage is really important in terms of the negotiation itself of the transaction. But just taking a step back, when we look at the value of M&A transactions, where the target company is of strategic value to the buyer, those are the transactions that result in the highest purchase price. That's opposed to acquisitions where our client as seller is providing an extra product or solution to a suite of products or solutions that already exist for the buyer. And then the other deals that we see that result in the lowest acquisition prices is where our client is adding a team and maybe a piece of the technology. So sometimes what you see in an acqui-hire type situation, but where it's strategic to the buyer, that's where we see the purchase prices being the highest. One example was a client that we had represented a while back that was pursuing a dual track IPO M&A transaction. This was a client of ours called Iron Planet. This was funded by Kleiner Perkins and Excel, and they were providing an online marketplace for the trading and sale of used equipment. Ultimately, right before their IPO, Caterpillar decided to buy them because Caterpillar did not have a significant online marketplace, and it had taken Iron Planet over a decade to build that technology solution. And this was a way in which a more traditional so-called brick and mortar business was able to have a significant technology component to their business. So we see a lot of companies that will be acquiring technology to provide a strategic element to their business, and it's a lot easier for them to buy than to build. And that's really what's going on in the minds of the buyers, is what is the cost of building versus buying, and to build may just take very long, and they're up against other competitors in the marketplace, and therefore time is of the essence for them to adopt a technology element to their business. So that's the big picture. If you're providing a strategic solution to a buyer, then you will gain the greatest value in that. In terms of the actual dynamics of the negotiation itself, maintaining leverage is incredibly important. First off, make sure that you have enough cash on your balance sheet to continue to operate your business, because one of the biggest problems in an acquisition is companies run out of cash and then they're out of options. So always make sure you have enough cash, because an acquisition process may take a lot longer than you expected. Second, make sure that you have multiple buyers that you're talking to. Create an auction-like situation so that you have multiple options. And that also includes venture financing. In fact, Mark and I are involved in an M&A transaction right now where the target company received multiple venture term sheets and also had an acquisition term sheet, and was able to leverage those venture term sheets to get a higher price in the acquisition. And we just got the LOI signed last week, but I think at a higher price than significantly higher price than the original bid. And that's because the buyer knew that our other alternative, our BATNA, best alternative to a negotiated solution, was to go the venture round and not get sold right now. So just a couple of suggestions as to how to maximize shareholder value, both in the long run and in the immediate negotiation.
I see. So again, I think this takes us back to the importance of negotiating the right things at the beginning of the process. As you have most leverage there, and leverage sounds like what you use to maximize value at the end of the day. So Mark, let us know if your thoughts on that as well. And also maybe you can kind of tell us what founders can focus on in this unruly process as they're trying to negotiate these terms to maximize value. What should they? There's a lot of stuff that's going on. You listed a few of them, and I think that was only a sliver of all the things that actually go on. So what should people focus on as sellers?
Yeah, when I'm advising founders, I try to get them to focus on three things. And if you look at the entirety of the sale process and the entirety of a 100-page merger agreement, for example, there are really three categories of items to keep your eye on the ball around. And if you can understand the import of different provisions as to these three items, you'll be ahead of the game in terms of understanding what matters, picking your battles, conceding things in the negotiations, and getting the deal optimized from your standpoint. And of course, we as lawyers are there to walk you through that and advise you every step of the way. Those three things are the following. One, getting the deal right. It's not just the headline price, but it's understanding the nuances of the various purchase price adjustments, what types of quote unquote indebtedness or other liabilities are for the seller's account, and adjust the purchase price. what types of transaction expenses are allocated to the seller as opposed to split between buyer and seller or covered by. So there's a whole slew of purchase price adjustments and mechanics. There's also valuation of stock issues in a combination stock and cash deal. There's also understanding the waterfall of a given company and making sure that all of the stakeholders are being treated in the transaction in accordance with their existing rights, so that you don't have security holders after the fact claiming misallocations or causing problems for you as a seller after the fact. So there's a great deal of time and energy going into getting the deal right and understanding what the economics of the deal and in compliance with existing security holder rights. Once you get to a signed deal, a lot of the provisions deal with deal execution risk. And that's the risk of having signed a deal, perhaps even announced it to the public, and failing to satisfy closing conditions and not getting the deal done. And so there's a lot of attention in a 100-page merger agreement about sellers being sure that they understand the closing conditions that they have to satisfy and push those as best they can to things that they can control. In every deal, there's things that are outside of the party's control, like regulatory approval and third-party consents and other things of that nature. But you want to have your eye on understanding what is the appropriate risk level between giving a buyer an option to back out of a deal through the failure of a closing condition, or to have closing conditions that the seller has largely control over and can assure that when the time comes and those closing conditions are satisfied, that the buyer is obligated to close. And then finally, there's a bucket of provisions that are negotiated regarding what post-closing strings are attached in the form of either post-closing indemnification exposure for breaches of reps and warranties that are made in the agreement, for claims by stakeholders, for third parties that make claims against the company, and different line item indemnities. And so you want to understand what the caps are, what the survival periods for those exposures are, who bears them. Is it pro rata among the various stakeholders? And there's also an opportunity, as I alluded to before, of really shifting the exposure from an indemnity construct to a rep and warranty insurance, where a third-party insurance provider would cover any losses that the buyer suffers. So if you really keep in mind getting the deal right, addressing deal execution risk between signing and closing, and understanding what the post-closing strings are attached in terms of potential future liability to have all or a portion of your purchase price clawed back. Virtually all of the action in this very detailed and minutia-driven and chaotic parallel processes of extreme work over a very condensed time period, they can really fall into those three buckets. And if you understand those and can allocate different issues at that are being negotiated within those buckets, it'll go a long way to understanding where to pick your battles and what is really important in negotiating these deals.
Yeah, and it's important, I think, and I think you both agree with me on this. It's important to use your capital and your kind of negotiating ammunition on the right things, and not fight on the wrong things, and kind of antagonize the situation and then not get the right things correct. And I'm sure we've all seen deals that have gone that way, and they're not that pleasant experience for anyone involved, and don't come out to the best outcome. More importantly, okay. I think we have time for one more thing, and I don't want to leave without getting your thoughts on this one, and that is tell the viewers about some surprises that might come up that people might not expect out of this process. John, why don't you start, and then Mark, we get your thoughts on that as well.
Right. Well, I think for first-time founders, I think they might not recognize or appreciate the amount of effort that goes into selling their company. As Mark alluded to earlier, it really requires a full team to get it done. And that's not only themselves as the founders of the company, but making sure they've got their shareholders on board, the employees on board, when it's the right time to reveal to the employees that the company is being acquired. it takes an entire team around the acquisition process. Saying that, however, what a lot of founders don't realize is, in most cases, it's their decision. The investors have backed their company, have placed a lot of bets on that team as the founding team, and ultimately the founders decide that it's the best thing to sell the company. In our experience, investors give a lot of deference to the founders, not only in terms of when or whether to sell, but who to sell to. And it may be that it's not necessarily the buyer that pays the highest price, but it could be the buyer that will put the team together in the best way that provides the best opportunity for the founders and the employees going forward in terms of the overall strategic fit. So founders should recognize that a lot of the decision, is in their hands about who and when and whether to sell the company.
Mark, any final thoughts?
Yeah, I would say in addition to just until you live it, you don't understand how intense it is. And as you mentioned, founders are doing 2, if not 3 jobs through these types of processes. The one thing that I would say it becomes a very big surprise is much like homeowners, if you defer maintenance in terms of record keeping, in terms of your capitalization table, in staying up to speed in documenting your open source, in complying with privacy issues, ensuring that you have invention assignments for IP. All of those things take much more time and cost more effort to fix when a problem arises and you have to fix it on the eve or on the cusp of selling the company, as opposed to getting good advice from the outset, developing your business and your company and growing it with the end game in mind, so that you're doing the maintenance issues as you go and avoid problems at the end. Invariably, we can't predict what curveball there is in a given deal, but every deal has a curveball or 2 that could have been prevented with a little foresight in how we run the business leading up to a transaction. And so I would say that, brace yourself for the first-time sellers. It's a complex and chaotic process. It's a process that for many of them is life-changing and worth the effort. Because it's the culmination of a lot of sweat equity in building value and returning to your investors and to yourself and your team a lot of value in addition to whatever the objective was in developing the technology from the outset. So it's a very chaotic and stressful process, but at the same time, it's a very rewarding process. We fashion ourselves as guides through the M&A sale process, and love all of the fantastic founders and technologies that we get to touch upon in this practice, and look forward to being advisors to you and your companies as you develop and have an opportunity to sell your company.
Well, I couldn't have summed it up better myself, so we'll just leave on that note. Mark, John, thanks for joining us, and hope to have both of you back on the show in future episodes. Thank you.
Thank you, Aria.
Thanks, Aria.